In this video, we're going to be discussing current mortgage interest rates and where they are right now, where they may be heading, and whether it's a good time for you to buy a house or not. I'm going to be interviewing Christian Gardner, who's an expert in the mortgage business. He's actually a mortgage broker. So let's get started and let's talk to Christian and see what we can learn about the interest rates and whether it's a good time to buy or not. Here we go. Okay, good morning, Christian. It's nice to be with you this morning here. If you would give us just a little background about you and your company and what you're currently, I know you're in the mortgage business, but can you kind of give us a little bit of an overlay of that before we kind of get down to the nitty gritty?
Yeah. So been a couple things through my life. Went to school, finance and economics, dual major. Ended up graduating with finance. The economics, I didn't see a real path. Graduated in 2011. If you remember, there was a recession going on. By my estimates, about 380,000 unemployed or critically employed folks in the finance business. So I kind of stayed in school a little bit longer than I needed to try to curve that a little bit.
Yeah.
Studied political science in Cambridge. I went across the pond for some broadening of my horizon, so to speak. Really enjoyed that. Got a good dive into culture. Came back here, worked as a forensic accountant, got married, went to work as a recruiter for Charter Spectrum, if you remember those. Remember those days? They used to be called Bright House. And went through that transition with them, and then had an opportunity to get into the mortgage lending business.
What year was that roughly that you got in the mortgage business?
2016. Started the conversation around 2015.
Okay. And you've been in the mortgage business ever since in one form or
Yes, sir. Yeah, I wouldn't do anything else now.
Now, what's the name of your company?
I'm with Waterstone Mortgage.
Okay.
We're based out of Wisconsin, Pewaukee, Wisconsin. I believe that's how you say it. Never been there. But we do have branches. We're licensed in all 48 states. Yeah, all 48. Not Alaska. I couldn't do business in Hawaii, and then New York we stay out of. There's a couple states that I find it fairly troublesome. More than happy to help folks out if that arises. But yeah, we can do business in 48 states.
Yeah, I can say this, if anybody might be interested in mortgage, I just know that my experience with you has been just amazing, and how hard you work for your customers, your clients, however you might reference them. So anyhow, that said, let's get to the topic, which is really kind of, I'd like you to maybe talk to us about where we are today in the mortgage business and in terms of rates, especially where we're heading. Any information you can share with us like that data might be helpful as well, but really kind of what's the state of the industry and what can we anticipate moving forward? Because I know a lot of people are sitting on the sidelines right now waiting for rates to come down. So can you give me some insight about all that?
Sure. And I do have some slides to help illustrate this. I could kind of talk about it, but without seeing it, a lot of times it loses its oomph. It's not exactly exciting information unless you're me.
Awesome. Okay.
I tend to geek out on this stuff a little bit, so try to keep it where it's makes sense.
Got it.
So it's a really exciting time, and I got some slides here. We're anticipating 2025 to be the best year in real estate in the history of the U.S.
Wait a minute.
We're saying.
Hold on. Say that again. The what now?
We're saying again, yeah, absolutely. 2025 is anticipated to be the best year in the history of the U.S. for real estate.
That's 2025, you're saying?
2025, yep.
That we're a little over a year out of that.
Got a little pain left to go, no doubt about it.
Yeah. When you say the best year in real estate business, do you mean, are you thinking in terms of the number of homes being sold? Is that what you're anticipating?
Bought, sold, and built.
Yeah. What's going to drive that, Christian?
Population growth, part of it. Folks realizing through the recession, sometimes it takes the tide to go out to see what's on the bottom. So as folks saw this and said, hey, maybe I'll rent for a long time, now we're starting to see those folks calling us saying, I got to own a home. It's been repeated time and time again. The biggest purchase you'll make per your income is going to be your primary residence. It's a great forced savings. It's compounding growth. Einstein said those that understand compounding benefit from it. Those that don't will pay into it. Yeah. So it takes all of these principles and it puts a roof over your head. So very few times in life can you throw $1 at one thing and get two solid benefits like a house and a home. Same structure, same building, bricks, tile, blah, blah, blah.
Got it.
But what it does, it keeps the rain off your head, and it also allows you to invest in something. And I call it investing in yourself. And I've been very proud of the people that I've worked with over the years. They've invested in themselves. They are being rewarded.
Sure they
I'm
are.
on the table on that. I love that.
Okay, so where are the interest rates today? Which today is, let's see, September the 20th, 2023. So someone could be viewing this way down the road. But on this date, where are interest rates right now? Where are we at the moment?
We're over 7. Ironically, today, Jerome Powell will speak at, I believe it's 2:00, the Fed rate decision.
Okay.
Nobody anticipates a hike, but we do anticipate a slight uptick in interest rates still. I believe that we'll touch 7.25. It's hard to tell with the news prints besides some of these other agencies, but we're at 7.25. Furthermore, there are points on the front end. Average right now, I believe, is right around 2 points on the front end. And if you think about it, what you pay up front to your note rate is about 2-to-1, maybe 3-to-1, depends on the time in history.
Mhm.
Right now, it's about 2-to-1. So
Mhm.
if we have a 7% interest rate with 2 points on the front end, then it's really about an 8% interest rate, maybe a little bit less.
So quick question, is a variable rate still a thing? Is that still happening out there? And does that give you a lower rate to start working with if a person was going to go down that path? Or is there even a path there anymore?
Yeah, so that's a great question. There's like 3, maybe 4 major components to it. Be real quick. There's not a lot of interest. So when there's not a lot of interest in something, there's not a lot of demand for it, hence not a lot of supply. There used to be about a point spread. If you take the risk, they'll give you about a point lower than what the market is. Right now, there's no demand for it, so there really isn't a lot of paper that is being drawn for it. Secondly, I believe adjustable and variable are different. Variables typically month over month, it can change, something along those lines. Adjustable typically is yearly or annually or semi-annually.
Well, maybe I
Right
used
now,
the wrong term there. That's bad on me, but
it's not. It's kind of interchangeable. From the seat I sit in, it matters. From the seat most other folks sit in, it's the same. Not sure that, but just to kind of clarify, your credit card would be variable. It changes, the interest rate changes. Sure. But an adjustable rate, it's going to be locked for a set amount of time. And then typically most of them are 6 months changes. It's becoming popular again. We actually have some programs that are starting to emerge as popular. Think about being at the top of something, and the only thing that can happen is the bottom can come out. That interest rate and an adjustable can go down.
Okay, let's get back to where we are today in terms of regular rates. We're over 7%. Where do you see that going, and what's going to happen there? I know right now, the price of housing is still pretty high. We're not seeing any real big drop in the market. There's a big problem with supply, which is driving the prices up. But do you anticipate rates dropping anytime in the near future? And if so, where will they go within the next year or two?
Yeah, you asked me this question 6 months ago, and it's kind of a blurry picture. As we've come into where we're at right now here today, I can say with a high degree of confidence, we're going to be somewhere between 5 and 6 within the next year and a half. 12 to 18 months is kind of the predictability, year and a half. And what's going to drive that? Yeah, supply demand. Builders are, I don't know if they're 100% yet, but they're getting up to speed. It is profitable to build again. The demand destruction at 7% versus 5%, for instance, it's in the average price of a home nowadays is about $370 a month. That's significant money. If we get back there, it's just more affordable.
Say that again. It's what did you just say? I missed that.
In the average price of a home, 2%, 7% to 5%, right? Yeah. It's about $370. I did some math here. I'm looking at my notes here, but it's about $370. $370.02 per month to go from a 7% that's on a 400,000 purchase price. Okay, so it's about $370 a month. Those 2 points. So I do believe that we will be back into those lower interest rates. The Fed has to take their foot off of the pedal.
Well, real quick, for those people sitting on the sidelines waiting for rates to drop even to the numbers you just mentioned, do you see rates ever going down to 3 or 4% ever again? I mean, do you think that's going to happen in the next 25 years?
No, I see us in recessionary periods. Yes, we could get back into the fours. And this is part of my thesis. Buy a house, own a home. And when you see that recession coming up and you'll hear about it on the news, call your lender and say, hey, I think lower rates are going to be on the horizon. This is my target is 4.25. Call me when they get there. Then I can put you on a list. When they hit 4.25, you get a call from me and I'll ask you for some documents.
But you think they will go to 4.25 again ever?
During a recession, yeah, that's what happens. So if let's say we exist in normal world, we never haven't my entire life, honestly, but let's say we exist in a normal world and it's 5.5% interest rates, and you make that payment for years, and then we go into a recession, it's going to dip maybe a full point, maybe more. And they do this to increase economic, the transactions that happen. That's when you want to refinance, but you can't purchase really a home because everybody jumps in, and there's going to be purchasers. I actually have a slide that talks about birth and when it happens, and if we look at different things, it's a pretty interesting analysis.
Now, in your mortgage world, what is the scuttlebutt on a recession these days? There was a big recession predicted. It really hasn't happened. A lot of the stuff that I'm seeing and hearing about, they don't really think it's going to happen, or if it is, it's going to be really light. So people who are sitting on the sidelines waiting for that recession to hit so that prices and rates, or at least rates go down, maybe prices go down. They're still sitting on the sidelines thinking there's a recession coming because that's what they heard over the last 18 months or so.
Sure.
What's going on? What's the conversation in the mortgage world about the recession?
It's a great question. We literally talked about this 2 days ago. So here's what we're seeing, that and here's, generally speaking, if you look at all the recessions, there's a housing recession that preempts a more global recession. And years ago it was, we were macroeconomic or microeconomic. Now we're macro, we're a global economy, but it precedes recessions by a very short time frame. To give you an idea, we talk about employment. Big numbers come out. We're watching it every month. What the unemployment. There have been about 50% erosion of loan officers in the U.S. So if we talk about a recession, and we can buy into the thesis that the housing, this market that I work in, the seat I sit in, precedes the rest of the economy, then we're technically in a recession right now. And then let's, fast forward a month or so. Now, here's the good news. It didn't last very long. And we only wiped out 50% of the loan officers in this industry. So it wasn't as
Wish you could do that with the real estate agents.
Oh, it already has. Yeah, no, it has. It's a little bit less. I think it's about 4. It's harder to measure realtors because some folks they won't do transactions. Sure. They don't necessarily leave a company or something. With loan officers, when we're not doing transactions or a company lays somebody off or they go out of business, a lot of companies have left the industry. Guaranteed Rate and some of these other guys, they're just gone for the most part.
Got it.
But those folks are taken out, and it's easy to measure because they no longer are employed. But realtors are a little bit harder. Most of them are 1099, and they don't necessarily leave a company. They're just not in transactions to happen.
Got it. So I know that you had some really good slides that I looked at yesterday. Do you have some in there that would maybe give us kind of a baseline of some of the things we're talking about without overwhelming us with data? Do you have some in there that you could show us that might make the light bulb go off of what's really going on and where we're heading?
Yeah, I would love to do that. Do you mind if I share my screen here?
Yeah, please do. Sure, absolutely.
Okay. Kind of new to this whole technology thing, so bear with me.
We got to get you up to speed.
Can you see me?
I can see you. Yeah, I don't see the slide yet though.
Okay.
It should be a one that says share screen, I think. There you go. There you go. Awesome. Look at you, rock star.
Now let's see if I can get this on the presentation mode.
There you go.
All right. Are you able to see my
I am.
screen?
Yes, sir. Go right ahead.
All right. Everything looked good. All right. That's me if anybody needs to contact me. So I talked a little bit about recessionary periods. The dark lines are recessions. There's many more recessions, and they're very thin and small. So they're not recognized on this chart. This goes back to 1960. The only time during these recessions that the actual prices of homes have dipped are going to be during the Great Recession, right around 2008.
Yeah.
You see that? In that time period there? It's the only time. So when we get to these recessions, and look how the spacing is. They're back here they were a little bit more. But there's a bunch of small ones in here that you don't really see. They don't show up on this infographic. But those are the times that you refinance. You wait
So
for
hold on a
those
second.
opportunities.
Hold on there a second. One
Yes, sir.
second. So the bottom line though is if someone's thinking about buying a house, even if they may feel like right now they're paying a little too much, and even if we go into a recession, their house is still 5, 10, 20 years from now, it's still going to be still would have gone up in value, so they have no fear of that. And I just heard you mention something about refinancing. So if I buy a house today,
Yep.
and I'm paying a rate that, let's say it's 7%, 7.25%, whatever, would good advice be for a person that if rates do drop, maybe go ahead and get in the market now while you can get in, while there's not that much competition? Would that be good advice? Go ahead and buy it now, and then down the road they can maybe refinance it? Is that?
Yeah, I've been beating the drum on this one. The
Okay.
7%, 7.25% interest rate is keeping a moat around purchases in general. And there are 1,400 plus people moving to the state of Florida during the pandemic, 440,000 to Texas, 417 to Florida. Those are the biggest migrations. So it's
Sure.
migration in. And yes, 7% is keeping a moat around buying in the state of Florida specifically.
But when you say keeping a moat, are you saying that I'm not sure what you mean by that. You're saying that?
Yes.
causing people-
So it's so it's a term, to keep folks out of something for a while. You'd like a castle, think about it, right? You'd put a moat around it and everybody
Sure.
would stay out of that.
Sure,
So
I see.
consider that moat at a 7%. Now it dries up at 5% and they can cross it pretty quickly.
Got it. Okay,
Yeah.
makes sense. Makes total sense.
So-
Okay, go ahead. I got you
Yeah.
off track. I'm sorry.
No. And that's what I'm beating the drum. That's what all of this says
Okay.
is buy now. And ideally it's pay later, but
Okay.
buy now, hold your nose and do it. And then you'll be rewarded down the road. So I talked about birth and I mentioned it. This is a great chart. If we look at the recession over on the left-hand side, you see my cursor moving around there?
Yeah, I see it, Chris. Okay, yeah.
Okay. I see what chart we're on. This is not really the side that I wanted to see, but that's okay. You get the idea. The blue line means formations. What a formation is when somebody's ready to buy a house. Whether that be they're married, they've got their kids, they're done renting, moving out of mom and dad, whatever that means, that's what that is. That's a household formation. The yellow line is completion. These are builders completing homes ready to move in. If you look at this is supply demand. Anytime you're this off, you're going to have problems. It just doesn't work. The cogs they crunch.
Sure.
Now that's the start of the recession. They kept building, and then now you see completions go down. Now we see it kind of catch up. Then we go here, we kind of move here. Let me move to the next chart. But what this is the completions versus the formations. And now you see house formations. Here we are, closer to here, where we're at today, and you see more formations than completions. Now, let's go back. 33 years is a magic number. I was actually born, this chart came out, they didn't ask me about it, but I was actually born in 1973. 3 years later, 1976 was the lowest amount since the World War II era, the baby boomers kind of thing. 1976 was the lowest amount of births, and we see it at like 3.2 million, something around in there. And then I'll go to the next chart. Like I said, there's not a ton of information to gather from these, but the comparison value. So most completions in history, kind of the same thing here. Now look at this. Here we are, 1990. Guess what happened 33 years later? We're in 2023.
Yeah.
So if I go backwards, here we are in 2023. Now look at these births moving forward. So this is 23, and I said 2025 is supposed to be the best year. Now look at the next 20 years. So arguably, you could say some of this, or maybe all of this recession was, the housing recession was blamed on people not having enough children. I blame my parents for that. No, the idea here is that it does
Sure.
mean something, and it does matter.
Yeah.
So a lot of people say, hey, I'll just rent. I don't know if that's such a great idea. So if you look at the available houses, right, currently, 2023 is where this goes down to less than 1%. But also keep in mind that some homes are just inhabitable. Some homes are sold and the loans are closed. We have construction to permanent loans. That means it's already done and closed. However, that home is not inhabitable. So that 3/4, that's a very small amount to begin with. Less than 1% of all homes in the US are uninhabited. There's a reason for it. They could have been burned down. Who knows? I don't know. Now we look to the vacancies down here. Now compare this to 2010 and that recession period as well. There was a lot of options. Supply, demand, I think is kind of what is indicated here.
Sure.
Inventory. We already saw kind of a chart, formations versus, but look at this. This is just incredible.
Yeah, wow. Yeah.
Yeah. This is, and we talk about inventory, supply, demand. So the question is, what happens when all those bursts come back into play?
Yeah.
What happens when that happens and we still have this inventory? Because we're not going to go from here to here. Keep in mind that was, during a time period when there were a lot of bursts at the top of that, or,
Sure.
prior it was over here. And this is we're not going to get back up into this median, into 2 million for quite some time. However, we do have another effect. And that is for inventory. And this should excite most realtors, that folks that have empty nesters will start looking for right sizing. The condo on the beach, no yard, no maintenance, just fun, retirement on the horizon kind of thing.
Sure.
This will vacate a home.
Well, real quick
Yep.
here, while we're talking about that, I was reading the other day about, and I forget what the percentage was, but the large percentage of homes out there that have no mortgage on them, that and the fact that so many people have low interest rates, that's impacting the availability. How does that from your perspective all play into the shortage and whether or not these people who want to buy are going to be able to have a place to even look at?
Yeah, that's the great conundrum there. So a couple things. Folks will, and I see it daily, they're calling me up and saying, hey, how do I get my equity without having to lose my 2%? Or I am mortgage free and I don't want a 7%. How do I do that?
Right. Yeah.
In today's day and age, there kind of is no way around it unless you're going to do something like a HELOC or a HELoan. We are introducing or just introduced a product. I think it goes live or just went live, and it's a HELoan, about $250,000, and it's a 15-year kind of plan. So if you're in the 2% and you have this equity, you don't necessarily need to get rid of that 2%. You can add a second on to it. The industry is very transformative. It will come out with products to suit the buyer's needs. There's all types of different products. They come out and then they'll go away. As the time and the era dictates, they will come out and go away. As far as that inventory, a lot of those folks that do have zero mortgage on their homes, they are getting ready for that retirement. I've got a chart here that shows the size of homes. It's pretty interesting. They were building bigger and bigger and bigger up until about 2020. Now they're kind of downsizing and building smaller. There are folks out there with 6-bedroom homes. The kids, the thought was everybody was going to come. They were going to live in a compound type. That didn't happen. We kind of went back to normal. Now these folks are standing around looking at 2,000, 3,000 square feet going, what do I do with it?
Yeah.
This is going to eventually lend itself to a vacancy.
But aren't boomers sort of driving that to some degree still, because they don't want as much space? Their kids are all obviously gone. They got a few grandkids, I guess, but are they driving that mindset of lesser square footage?
Absolutely. This society, and it's happened kind of quietly, kind of loud at first, but we have turned from a society of things to a society of experiences. There was an actual invention I thought was brilliant, not really, kind of in between, but it was called a tiny home. It's a brilliant invention. It satisfies a lot of issues that the world has as far as housing. But I think it's too small for a lot of people. But the idea is that if I don't do this, I can do something else in life. You're absolutely right. Boomers are driving a lot of this. This is too much house. My wife and myself live in 1,600 square feet, but we really only live in about 800 of it. I mean, it's kind of crazy looking at it. But, when I bought the house, I was like, oh, I need every square inch.
Yeah, but your wife told me she needed that extra room so she could get rid of you at times and get you out of her hair.
She's digging a hole in the concrete, and I got a feeling she's got a couple of bags of Quikrete next to it. So my wife and I say we're building our tomb, but I can guarantee now that I see other odd items out there, and I like the tiny home. If they were a little bit bigger, I would love the tiny home.
Sure.
So This is an interesting chart. This kind of gets into a couple different charts. Look at the greens on here. How many years has housing prices gone down? So the question is my investment protected? Am I going to lose money on it? We are hyper focused on 2007 through 2011.
Right.
Look at the so 1943. I think that's around the time period they came out with the 30-year mortgage. So before that there was a 20 or 15, I believe, and then there was some different options, lots of balloons and things around that time period. We were still fairly an agrarian society, so it makes sense that you put out a 30-year mortgage, stretching the payment out, twice as long as it maybe had ever been. All of a sudden, people are going to be able to afford homes. That's likely what that is. I'm not a real history buff, and I'm a loan officer, not a school teacher by any stretch. Sometimes, but you never know. So we see these big balloons, but look at this: 43 years without a drop.
Impressive. Yeah.
I don't know that you can find me too many investments.
Yeah.
Now, that same house is going to keep. Now, my house was built in 1967, and I still have that house. I still have this house. It's not like these things go away. Not like a lot of investments. The only companies that are still around from the same era are going to be things like McDonald's and Coca-Cola, Budweiser, Anheuser-Busch. Those are the only businesses that. So think about housing outlasting, for the most part, businesses. If you look at these compounding prices, like I had mentioned earlier, those that understand it benefit from it. Those that don't pay into it. Think about that statement: renters versus buyers.
Well, Christian, I would also think that my focus is certainly the state of Florida, and certainly in the St. Pete, Clearwater, Treasure Island, where I live area, that particular area. And
yeah,
there's not a lot of land to be building anything. So I would think any kind of investment in this area, especially because of the lack of newer homes being built, whatever you buy, it's just a no-brainer. It's just going to keep going up and up. Even I realize the chart explains that very well, but just common sense tells you, you don't have a lot of competition in terms of other houses for sale if you put yours on the market.
Yeah. There's And we've seen a phenomena that I certainly haven't seen in my experience. And my experience is somewhat limited, but yeah, we're seeing sellers that are holding off putting their houses on the market. Two reasons: they're going to go buy a house, they're going to have a 7% interest rate. Second reason is they feel like there's been enough price softening, and now we're getting to the end of the year, et cetera, that with lower interest rates, they'll have this, and this is why we're saying buy now and refinance later, because the competition is going to be there. The cost of waiting, and I have a slide that shows you sometimes, or shows you kind of what we say about 10%. If the average home is 400,000, which it is, a 10%, if you're going to wait till next year, you're going to pay $40,000 more.
So let's go back to it. Let's just drill down on just a piece there. You mentioned competition. So right now, because interest rates are high, there's not that many people out there trying to buy houses. So there's not as many bidding wars as we had back when it was 3 or 4%. If interest rate, when the interest rates do come down, like I think what I just heard you say, is there'll be more competition, more people in the market, and that's when the bidding for the houses starts, and that's when the prices go up. So if you're thinking about buying, you need to buy now and do what you said a second ago. Think about refinance. I'm being repetitive here, but I think it's worth us emphasizing to anybody who might be watching this video.
Pound that drum, because that is the truth. That's the reality of it. Unfortunately, it doesn't. We watch the news. That's where we get our news from. Unfortunately, nowadays, we don't get it from Case Shiller and FHFA. We get it from these news blurbs and headlines. But pound that drum. That 7% is creating a moat around Florida. We are in a temporary buyer's market. It's been arguably a seller's market for the last since end of 2020, but we're in a temporary buyer's market. And because of the interest rates being high, we're getting full seller credits right now. The seller is giving the buyer money to buy the house from them. In normal markets, there's a little bit of that, right? 2%, 3%. In today's market, FHA goes up to 6%. I did a couple deals in the middle of this year, June, July, that were full seller credits. In order to get these deals done, the at 5% and 6%, there is marketably more opportunity for first-time home buyers. You can't sell your third home unless there's, it's a domino, right? unless there's somebody coming in and buying kind of that starter home, that 3-2 or that that 2-1 or 2-2 I'm seeing a lot of. Unless somebody's coming in and buying those people can't sell that and move into the the 3-2 with the pool, and those guys can't move into the on through the 11 homes that people at on average own to get into that final home, which is that condo with no yard and no maintenance.
I think the majority of the people out here, though, oftentimes in their heads are looking for that dream home, and it's got to have these 10 bullet points. And you would be better off not to have all 10 bullet points and have 7 of them, not get your dream home now, but get in the market so that you can take advantage of the appreciation of the house and build yourself some assets and some wealth. So I think it's important.
Yeah. Would you rather have $1 or $0 back in your pocket every time you pay rent?
Right.
How about $300 or no dollars? That's kind of where the mortgage is. When you have a mortgage, you're paying principal down. So it's really when somebody says, "What's my full payment?" You can say your full payment plus you're going to put this money in your back pocket. So what you actually lose is this amount. Absolutely. And then you can add compounding. I mean, you can get pretty detailed into it. I find that it typically goes over like a lead balloon. Doesn't. Anyway, so yeah, I mean, there's only 7 years since 1942 that we've had drops.
Yep. Okay.
That's pretty impressive. I kind of talked about this. Wanted to reiterate, when you look at these two charts next to each other, we just don't have enough inventory. Prices are expected to go up. I'll just kind of continue through this. So what's the 3 biggest driving inventory? Supply, demand, demographics. The folks, we saw the birth charts there. 1990 we saw the highest, and 1976 we saw the lowest. So this year literally we're at the highest. These folks want to buy homes. I've talked with these folks. I've talked with these IT individuals. Man, they are just wicked smart. They know what they want. Somebody told me a long time ago, price is what you pay, value is what you get. These folks are focused on value. What does it do for me in the future? Why am I doing this? Why am I taking the closing cost and the down payment? Why am I taking all this money out of my pocket that I saved for? It's an investment. So these folks already understand that. You just have to show them that it happens. And that's exactly what this whole presentation does. And then lending standards. So part of the recession, what earmarked the Great Recession, those 5 years, the only 5 years in a row that have ever been negative, back to back, is because the lending standards were too loose. In today's world, 90 days late, less than 1%. 90 days is an important measure when you're late on mortgage payments. It indicates 3 months of non-payment, obviously, but it also is a time frame when lis pendens or foreclosure proceedings start. So that's a big number. So less than 1%. Remember that chart where it said vacancies less than 1%? Yeah, same thing. So the 30-day lates, right? Some people forget to make a payment. They look at this number. They don't even look at 60s. They do, but they consider it really 230s. But when the 30-day, it's less than 3% or just over 3%. It hovers around that 3%. That's historically the lowest numbers ever. So this market is healthy. If you're worried about your investment, bottom falling out, no money, kind of what we saw in 2007, not going to happen again.
Christian, since you mentioned lending standards, let's talk about that for just a second. In today's world, a buyer that's going to go out and buy something, they need a proof of funds, or they need a pre-approval letter. Can you address that for just a second in terms of what your company does when someone makes a request? I think what I'm leading up to is that if someone's thinking about buying, I know from past experience, if they reach out to you, give you a few pieces of information, you can generate them a pre-approval letter. Am I using the right terminology?
Yep. So I'll go through the real quick process. So we do a phone consultation. Hey, what do you want? What are you doing? My name is this, blah, blah, blah. So we kind of go through that. It's usually the longest time you ever have to talk to me. I just want to get to know you. More importantly, can we work together? If we can't do the easy stuff, it's going to be real hard when, this is a big purchase. This isn't buying a pack of cards here. This
so the first step is an interview with you.
Mm-hmm. So then we, I'm gonna try to switch screens here. So I think I lost something in all of that Can you see my chart
I
again?
can. Yeah. Yep.
Okay. So yeah, so then what I'll do is I'll send out, in my email, there's a ribbon in there that says, click here, it'll send you my website. You fill out an online application. Nobody likes doing them. They're pretty simple. It takes 20, 30 minutes. Then I get back on my side. I do a soft credit pull. Now it doesn't set off any bells or whistles. It's a soft credit pull. We ask you to opt out because the economy is bad. Trigger leads, you get 20 phone calls or you get no phone calls. I elect no phone calls, so I ask you to opt out. Once we do that, we can do a hard credit pull. We can ask for pay stubs, W-2s, income, assets is what we're looking at. Credit, we've already done a soft pull. And then is all we're waiting on at that point is the collateral, the house, the home that we're going to purchase. So we'll go through that process. We'll actually go to underwriting, and we'll get a pre-approval. Now, once I examine those documents, I can get a pre-approval to you. I can also go to underwriting, and I submit you so we can get a conditional pre-approval. Conditional means, hey, if you can do these, you can satisfy these conditions, we'll put you in a home. We'll give you the money. So that's the point that I say, get out there, get shopping. But I don't stop there on my end. I continue with the process. I satisfy those conditions. I'll ask the borrower, hey, give me the pay stubs, I need one more bank statement, whatever it is. I submit it back to underwriting while you're out there shopping. Now, it's a race. Maybe you find a home within 24 hours. Not likely in today's world. Usually takes about 10, 15, maybe even 20 days now. But I will be back from underwriting and I'll have a full approval. When we get back into this, this next boom of purchases and refinance, it's all gonna be, fairly fast moving. Having an approval, a guarantee to lend, having all of the heavy lifting for the finance aspect of it done, walking in there, putting an offer down and saying, I'm not going to dime higher because I have a loan that will close. I've got a guarantee to lend. That is powerful. So when a seller, and you remember these markets a couple of years ago, in 21, has 20 offers on their table, 20. I've helped realtors go through these offers. Yeah. They're just crazy. They're all over the map. But then I have one with an approval, guarantee to lend on it. I'm gonna say I don't care what the offer is. This one's got to go to the top. This one we don't have to worry about, and we can probably close in 10, 15 days. Sure. So that one goes to the top. Then we filter through all the rest of them. Now, think about all the power that gives you. So I want this, and I know you got 20 offers, but I want a seller credit. It really gives the buyer a lot of power. I can't tell you, because we saw during the pandemic, it got so crazy. Other lenders were just whipping out pre-approvals. Didn't look at a single. I saw one from Bank of America. They never even picked up the file. And I don't want to be disparaging on anybody because it happens. Things are moving so fast. You get phone calls. I need this. I need that. Right. You've had one conversation. The earlier we can get them in the process. Whether you want to call it mortgage planning or just checking, dotting your I's and crossing your T's kind of thing. Having that approval in your hand versus a conditional pre-approval versus a pre-approval versus a qualification, that's where you get it.
Got it. Kristen, is there a minimum credit score someone needs before you can really give them that sort of, I realize it's credit and all that, but is there a minimum credit score that a person needs to keep in mind if they're trying to get a pre-approval letter?
Yeah. In today's day and age, 580 is really where you want to be. So FHA minimum credit score is 580. FHA has what's called expanded credit, expanded guidelines, but it really is expanded credit guidelines. Okay. If you want, and you're looking for, let's say, a second or a third home, we really want to go conventional because we're probably selling a home and, putting at least 20, maybe 50% down on the next home. We really want to see and want to be at a credit score somewhere 640 and higher. Okay. Because of where we're at in society, or in our economic cycle right now, the dial has been turned up. It's more expensive. They want it to slow down intentionally. That's what the whole Fed is trying to do, demand destruction. And one of the ways you can do this is slow down lending, and the easier way to do it. We saw in the recession, some of the lenders, now 580 is FHA, that's what they say. And it can go lower under certain circumstances, but 580 is what they say. We saw lenders at the beginning of the recession, they wanted to slow down the lending. So what they did was they increased their credit score for FHA. I saw it as high as 620. We weren't one of those companies that did that, but I understand the thought process behind it because some of those borrowers are no longer going to qualify because of credit.
Okay, cool. Christian, we're about to run out of time here a little bit.
Yes, sir.
Can you take us through the rest of these slides and the pertinent bullet points and kind of let us kind of wrap this up?
Absolutely. This is month over month. The yellow is all-time highs. The reason Case-Shiller isn't all-time high, it actually measures cash transactions. You can see how cash is leaving the market. You can see that that's why that's not as high. FHFA, CoreLogic, blah, blah, blah. Those are all reading. And then you see the 2023 pace. CoreLogic is the one that we look at a lot, 10%. Zillow is the one that most other people look at a lot. They seem to be in pretty much unison.
Okay.
It is not wanting to go forward on me. I think my presentation's stuck here. So why don't we just end it here?
Okay, cool.
Yeah, not sure what happened.
That's all right. If you're watching this video, I want to emphasize to you again that if you need help with a mortgage, Christian is amazing. He works really, really hard. You heard him talk about the process he goes through, and really the whole crux of this presentation was really kind of talk about where rates are and where they're going, and should you buy now. So I think there's a lot of reasons to buy now. I would think that naturally because I'm a realtor, but maybe you do need to sit on the sidelines for a bit longer. But I think in the long run, sitting on the sidelines is probably going to cost you more money. Christian, would you agree with that? I'm sure you would.
Yeah, I absolutely do. That's like I said, and I can't say it loud enough or long enough or as many times as I really want to, but 7.25% interest rate are going to keep other folks out of the market. We were marketing to folks moving to Florida. I don't know, about a year ago. We stopped that. Now we're hyper focused on renters and owners, that people that want to be owners in Florida get on this bandwagon while we still can. The monthly outflow is what we're all concerned about. I keep telling folks, everybody saves money on the 2-1 buy down. Sellers save money on the 2-1 buy down. Buyers save monthly money. It's what's most important to them. I saw somebody have 2 price reductions for about $20,000 when the folks that wanted to buy the house, they wanted to go up over that price, get a 2-1 buy down because their concern was monthly, and then the seller ended up missing out on about $4,000 or $5,000.
Wow.
It's just an explanation. It's the same dollar. It's a seller credit. It just makes a lot of sense, and there's ways to work around that. But yeah, use these 7% and then develop a plan to refinance. If you're buying your second or your third home and the credit card debt has got high, consider refinancing, cash out, pay down the credit card. Keep in mind when you want to sell, let's call it 6 months down, you're only going to make 3 payments at that higher interest rate. Then you're going to buy your next house. The credit's going to be gone. The credit scores are going to be high. You're confident by. It just makes a lot of sense to be able to utilize some of this, even though we kind of want to hold our noses at 7%. And I'm right there with you.
Absolutely. Hey, this is Christian Gardner. If you need help with a mortgage, reach out to Christian. I'm Tommy Gibbs. And if you need to buy or sell a house, I'm your man. Hey, thanks for watching the video and have a great day.